Ever wondered how banks manage their money? Two important terms you should know about are SLR and CRR. These play a key role in regulating how much money banks can lend out and keep in reserve. Let's start with CRR, the cash reserve ratio. This is the percentage of a bank's total deposits that must be kept as cash reserves with the Reserve Bank of India, RBI. In simple terms, banks can't lend out all the money you deposit, they must keep a certain portion in reserve. The purpose is to ensure that banks have enough liquidity to meet withdrawal demands from customers. It's kept with the RBI as cash reserves. The percentage is set by the RBI, currently around 4 to 5%, but may change. A higher CRR means banks have less money to lend, reducing liquidity in the economy. For example, if the CRR is 4%, this means for every 100 Indian rupees deposited, the bank must keep 4 Indian rupees with the RBI and can only use the remaining 96 Indian rupees for loans or investments. Next, we have SLR, the statutory liquidity ratio. This is the percentage of a bank's total deposits that must be invested in safe, liquid assets like government securities, gold, or cash. The idea here is to ensure banks maintain a buffer of safe investments, ready to be converted into cash in case of emergencies. The purpose is to ensure banks maintain solvency and have enough liquid assets to meet short-term obligations. It's kept in government bonds, gold, or other liquid assets. The percentage is also set by the RBI, currently around 18 to 22%, but subject to change. A higher SLR reduces the amount of money banks can lend, but provides security to the banking system. For instance, if the SLR is 18%, out of every 100 Indian rupees deposited, 18 Indian rupees must be invested in liquid assets like government bonds, ensuring the bank is financially stable. Now that we know what CRR and SLR are, let's quickly compare the two. CRR is a cash reserve that banks must keep with the RBI. SLR is an investment in liquid assets like government securities or gold that the bank holds itself. CRR affects immediate liquidity as it's cash held with the RBI. SLR affects solvency by ensuring banks have enough safe assets. Both CRR and SLR control the money supply in the economy. When the RBI raises either the CRR or SLR, banks have less money to lend, which can slow down inflation. Lowering them has the opposite effect, allowing banks to lend more and stimulate the economy. So, why should you care about CRR and SLR? Well, they directly affect how much banks can lend and how quickly they can meet your withdrawal requests. They also play a role in determining loan interest rates and the overall health of the economy. In summary, CRR is the cash banks keep with the RBI, and SLR is the investment in safe assets. Both ensure that banks are financially healthy and have enough reserves to operate safely. Understanding these two concepts helps you see how banks manage risk while keeping your money safe. Thank you for watching, and don't forget to stay informed about how your money moves.